Good afternoon, everyone, and welcome to today's weekly market insights. Now, as we have a look across to the calendar, a relatively quiet economic calendar for us this week. But if we break it down, we can see on Monday we had a speech from Christine Lagarde. On Tuesday, we also had a speech from Christine Lagarde. On Wednesday, we had a speech from Christine Lagarde, and twice today we have had a speech from Christine Lagarde. Once this morning and once this evening at 6:45. So we can kind of write 5 events off this calendar for this week because we have not had a great deal of action come out of those meetings so far. Now, as we have a look to the calendar to see what actually can impact markets for us this week, it comes to the UK, comes to the British pound, comes a bit closer to home. We can see here claimant count change and the unemployment rate was Tuesday's figures. And obviously on Wednesday, we can see here was the inflation figures out of the UK. Now, they were positive across the board. We can see here that we look to employment, the unemployment rate ticked down. We also had inflation tick up. So they are both strong numbers in the Bank of England's thinking for further monetary policy adjustments. Now, as we tick on the medium impact data releases, we can come back down the calendar to today, to this morning. We have also had a raft of positive retail sales numbers out of the UK. So that kind of does it tie the Bank of England's hands in terms of hiking rates next month. Some analysts, some market participants seem to believe so. It remains to be seen whether this is the case, but we've had strong employment, we've had strong inflation, and we've also had strong retail sales, consumer demand out of the UK. So you would imagine in normal circumstances that is legitimate reasons for at least speaking about hiking rates. Whether they do or not at the next meeting remains to be seen, but as I said before, some market participants seem to believe that the writing is on the wall for that. Now, as we tick this back to the calendar, the next thing is it's pretty much about broad dollar strength this week. As I bring you across to these charts, we can see downside in the Aussie, we can see downside in the Kiwi, we can see downside in Euro. Sterling has kind of chopped a bit, it's grinded a little bit upwards, but that's strength working against strength at the moment. So that's kind of natural that we get a bit of choppiness out of strength against strength. We get the US dollar higher against the yen, higher against Swiss franc, and higher against the Canadian dollar. Now, throughout the week, we've had a few comments out of Fed speakers, but the main source of information for us this week was the fact that the Fed believe that we are seeing broader based increases of inflation. Comments out of New York's Fed's Williams as of yesterday. Now, he is a known dove in the FOMC. He's a known dove in the Fed. So when a dovish member of the Fed or any central bank, when a dovish member of a central bank comes out with hawkish comments, it is something that markets listen to. Now, if he's saying that inflation is more broader based than they initially thought, it means that sectors of the economy that were initially impacted by COVID that are bouncing back, obviously we are going to see increased inflation in those sorts of sectors, but now it is widening to sectors of the economy that can, to every sector of the economy. So it is definitely something we are going to have to look at more into the future. Plus, you couple that with the fact that ECB Governing Council member Isabel Schnabel said that the rise in inflation was a welcome development. Now, if the US are worrying about inflation, and Europe are welcoming inflation, that means that they are on different paths in terms of monetary policy. She also noted that the fact that the ECB are continuing to buy bonds was a sign that a rate hike was not imminent. Now, as we look to the US, we look to the Fed. In terms of rate hikes, we are predicting, market participants and some analysts are predicting that we may see a rate hike further than initially anticipated because inflation is high. But in the ECB, on the flip side, inflation's been low for so long. So that a little bit of inflation is a welcome development. Plus the fact that they are not looking to hike interest rates anywhere within the next couple of years means that the two central banks are on diverging monetary policy paths, which we can see. We can see the downside in euro dollar, which is sped up by the fact that we've got a couple of Couple of central banks. If I zoom out here, now that's the 4-hour time frames. Look at this chart down the bottom left. As we can see, that's back towards June. We've had a pretty strong clear downtrend in euro dollar over the past number of months, proving the fact that we have got two central banks deferring on monetary policy. Now, as we come across here, one thing I would say, we'll come across the indices now in a second, but one thing I want to look at is the US dollar against the Turkish lira. Now, Turkey has slashed interest rates yesterday, and they did send the lira tumbling more than 6% after the president, Erdogan, he's got a fixation on low borrowing costs, which will potentially worsen very strong inflation. So whatever goes on in Turkey, I am not so sure, but we can see if we blow up this chart a bit, we are at all-time lows in terms of the Turkish lira. You've got a clear uptrend for years at this point, but you see this move, it is just a vertical line up, does not make for a great look for the Turkish economy at the moment. Now, as we look towards today's price movements, we can see here on the Dow Jones US index, we had a big sell-off earlier on today. We look at the DAX, we had a pretty big sell-off earlier on today, which, it's not a complete massacre, but we can see some pretty strong selling there this morning. Now, the reasons for that are put down to Austria becoming the first Western European country to impose widespread restrictions across their country and make vaccines mandatory for the people who live in the country who are not vaccinated. Now, that is a big step from a country in Europe. As we, are we to expect more countries from Europe throughout the next coming weeks and months to agree to that as well? It seemed to have caused a sell-off in global equities this morning. Germany have become more open to the fact this morning that they may have to lock down, which is another positive towards equities. Certainly, if we look at the DAX, as the German economy is the largest economy in the Eurozone. But if we come across to this case figures website that I have now, if we look at Austria, you can see the cases, this green line here, they are rising exponentially at the moment. It's crazy the speed in which cases are growing in Austria. We can see Germany as well ticking up, potentially having, Angela Merkel has said that we could potentially expect some restrictions across Christmas, which is not good for the global economy if we have got countries who are vaccinated deciding to lock down. Now, Austria's vaccination limit is not as high as other countries, but we see here the cases are rising exponentially. Even in the UK, we're ticking up a bit, but perhaps the more alarming fact is if we come across here to confirmed deaths, we can see Germany's deaths rising. We can also see Austria's deaths rising exponentially. It's a vertical increase in the deaths. A lot of those people are not, I don't say a lot, I'm not sure the exact figures, but many of those people are not vaccinated. But in Germany, it's a different story. A lot of the population are vaccinated, and we have still got these deaths rising pretty suddenly, which is the reason for equity sell-off this morning. But it remains to be seen whether we get any more countries locking down in terms of a complete massacre across equities. We've not got that this morning, but if multiple countries across Europe decide to lock down again, maybe we need to look at the equity markets a little bit more carefully in the coming weeks and months ahead. Now, as we come across the next week, in terms of a calendar, we've got a rate decision out of the PBOC, the People's Bank of China. We've got a few PMIs out of Germany, Europe, and the UK. We've got a rate statement out of the RBNZ on Wednesday. They are expected to hike rates by a further 0.25%, but it has not been ruled out by analysts that we could see a further 0.5% increase in the interest rate in New Zealand, which would bring it to 1%, which would certainly be quite high compared to other central banks at the moment. We've also got the minutes, but apart from that, GDP and Thanksgiving Day on Thursday are the other things we got to look at. Thursday, Thanksgiving Day on the US, may mean some low liquidity, low volatility, maybe not some great opportunities on Thursday, but we will cross that bridge when it comes to it. Now, I'm going to wrap it up there. That's all from us today, and please do join us next week for another weekly market insights. Thank you.